and welcome to all of you. And I should say congratulations for getting here, because I'm keenly aware that this is one of the last sessions of the festival. You're probably pretty exhausted, your brain's probably exploding. I'm also aware that the sunshine has just come out, hooray. So congratulations for not rushing off and hiking. And I also know that the title of this session, to be honest, is pretty deadly boring. How green can big banks be? You know, so unless you're working in banking or in green policy making, you're probably going, ugh, at this point. So I'm going to rename it and call it, Are We All Going to Burn? And what can business, what can business and finance do to stop that? Because the reason I'm moderating this panel is that I work with the Financial Times. About 3 years ago, I created a newsletter that goes out 3 times a week in a platform called Moral Money that looks at sustainability. We cover stuff that sounds endlessly boring most of the time to ordinary people, to do with the fact that in the last year, the big banks have pledged, and asset managers made pledges which imply that around $150 trillion worth of assets are going to be rechanneled to try and support measures against climate change. At the same time, the central banks have come out with a lot of moves. Governments have come out with moves. There's new reporting and accounting systems with ghastly acronyms like TCFD, ISSB, etc., etc. I suggest we don't discuss the fine details of those, or you really will all leave and go hiking. But there's been a lot of action. But the question really is all of this frenetic action in the financial system actually making a difference? Is it the right thing to do? Should you, with your money, be looking at ways to deploy it in ways that will actually support it, or is it just a smokescreen? And what does that mean politically in terms of what we're seeing now? Because as hopefully most of you know, in the last 12 hours, we've had a pretty big shock for the investing and green world, which is the Supreme Court has come out with a strong decision about the EPA. I'm going to be asking them to explain what this means in a moment. And we're seeing an extraordinary overt and covert backlash amongst Republicans and other right-wing groups against all of these efforts to try and channel finance and business to fight climate change. Down in the geeky weeds, there is a war going on. And that is what we're going to be talking about. And we have 2 absolutely fantastic people to talk to us about it today. One is Michael Sheren, who, in spite of the fact he has an American accent, is working at the Bank of England, or has been, as senior advisor on climate change issues in recent years. He lives in London with an American accent. I live in New York with a British accent. Go figure. But he's got a long experience in finance, 25 years, 30 years, as an investment banker, doing all kinds of things that he says he now regrets, like financing oil and gas companies and doing LBOs and things like that. But you're now very much working to try and turn the financial system around, and previously also wrote a key report for the G20 about this, now teaching at Cambridge University. And we have Sarah Bloom-Raskin, who is a distinguished professor of law at Duke University, previously was number 2 at the Treasury, also been a Fed governor, also, though, most crucially for this debate, been a champion of measures to combat climate change using finance and business, and so much so that she attracted the ire of the Republicans and sparked a very intense campaign against her that we'll come to in a moment. So, 2 people who are in great positions to tell us what's happening in this war over the geeky weeds of climate change. Sarah, I'd like to start with you. As with your legal professor hat on, can you give the students here a 2-minute class on what the heck happened this morning with the Supreme Court, and explain to us why Paul Krugman said this morning in a tweet that although the overturning of Roe versus Wade was shocking, the decision that happened this morning, Paul Krugman thinks, is actually even more significant.
Oh boy, okay. Well, first of all, happy to be here. And I'll say a little bit about today's ruling. So it did come out at 10 this morning.
As you can see, she's prepared with her notes.
I want to get it right.
All morning.
So it was called West Virginia versus EPA. okay? And what it had to do with is whether the EPA, the Environmental Protection Agency in the US, whether it has the power to regulate carbon dioxide emissions from power plants, okay? That was the challenge. And it was actually a very, it was a case with a kind of interesting, sort of a bizarre kind of history that it even got to the Supreme Court. But the top line here is that the Supreme Court held in a 6-3 decision that the EPA doesn't have that authority, okay? So the reason the court said the EPA doesn't have that authority is because there is not specific authorization from Congress to do this, okay? And this is going to be the piece having to do with, it has to do with delegation theory, and this is what I think Paul Krugman is getting at with his tweet. But the effect of this, of course, is that this holding is going to limit the ability of the EPA to use policy tools to address climate change. So what did Chief Justice Roberts say? So he wrote the opinion on this, and he said essentially there was no clear congressional authorization for the EPA to cap CO2 emissions. And so the effect here really goes into the question of delegation. Now, the reason why there are agencies, expert agencies, is that, the view is that Congress isn't going to have all of the expertise necessary to make very specific decisions. And so the theory is you have these agencies that are authorized by law, and you give these agencies some of the hardest questions to deal with, because heaven knows Congress can't do it. They don't have the bandwidth, and they certainly don't have the expertise. So agencies with specialized understanding and people with relevant experience come and work in these agencies and make the relevant decisions. So the issue here, beyond the issue of whether, what are we going to do, what's the EPA going to do about losing this important lever to combat climate change, the bigger question is, well, what does this say about delegation of all regulatory responsibilities? Does this mean essentially that many regulatory actions, not just in the environmental space, but say in the financial regulatory space, in the health space, in safety aspects, do all of these regulations have to be looked at again? And going forward, what must Congress do before an agency is allowed to kind of pick up the baton and do a meaningful regulation? So that is kind of the bigger question. Now, I said this was a bizarre case. The reason it was bizarre was because the facts were such that it was what the Supreme Court was looking at was President Obama's Clean Power Plan. Okay, so there was a Clean Power Plan, and it essentially was a plan that was going to attempt to cut greenhouse gas emissions from power plants. And for the scientists in the room, greenhouse gas emissions from power plants are the second largest source of CO2 in the US. So it was really a plan, not a regulation, but the plan, it turned out, was scrapped. Before it even became litigated, people in the White House said, we're not actually going to go this direction. We're not going to implement the Clean Power Plan. Instead, another plan was put up, and that plan was challenged. That plan was struck down. But meanwhile, the Clean Power Plan is not a plan that actually ever came into fruition. Somebody said it was, it no longer exists, it never took effect, and it wouldn't have made a difference. But that was what was challenged. And it was interesting because there was a side issue, like, how does the Supreme Court even have the authority to make a decision on a plan that doesn't exist? So there was that kind of sidebar. And this might go, Gillian, to the question of, this kind of being a concerted strategy of looking at the whole sort of administrative expert agency state.
Absolutely. I mean, I don't know how many law students or lawyers we have in the room, but you certainly had a very good summary from Professor Raskin here. The question I have really is, does this mean that the Supreme Court now has the ability to knock back a lot of the climate change regulation and initiatives that's coming out of the government at the moment? Because if the Supreme Court ruling means that basically the EPA and other agencies are kind of toothless now unless Congress does something, and no one's going to bet on Congress doing anything swiftly, if at all, then does that mean that everything the agencies are doing, the EPA are doing, is not going to happen? Because there's something else incredibly important going on right now, which is the SEC is drawing up huge regulation that's going to change the accounting framework for companies to take notice of climate change. Is that now going to be on the metaphorical bonfire as well?
It's a great question. So this is really the next legal analysis. You'll start seeing the articles and commentaries on this question in the next coming days, because that's going to go to how broad is that opinion, okay? For example, we know the SEC, the Fed, they're considered independent. But then again, so is the EPA. So what exactly will be the guardrails that will exist that will actually, keep these agencies from being completely toothless? So the language of the opinion will get looked at very carefully. I've got to tell you, though, there was a strong dissent here from Justice Kagan, who, said that, the court appoints itself instead of Congress or the expert agency as the decision maker on climate policy. I cannot think of many things more frightening. Okay, so this is in the dissent, right? So you can see the sense that this is a potentially very broad holding and that it could go to provisions and possible rulemakings that are in the works right now.
Now, the thing I find fascinating about this, and I want to come back in a moment and talk a bit more about the legal backlash in the weeds and what's happening in the States, which has largely gone unnoticed. But before I do that, I'd like to turn to you, Michael, because you're sitting in London, where Mark Carney, the former Bank of England governor, has been at the forefront of pushing the global financial system and the central banks to race ahead with measures to combat climate change. So my first question really is, how does this look to you, what's happened with the Supreme Court in London? I mean, do you have the sense that Europe and the US are just going on completely different policy paths right now in terms of climate change?
Yeah, this is completely shocking. When Mark came into the Bank of England, he very quickly had determined, and I think he had determined as well beforehand, that climate change is a risk to the financial system. And that's our job as a regulator, as a central bank, to understand where the prudential risks are. At the time, we were particularly lucky because Mark was also the head of the FSB. Sorry for using the acronym. It's the Financial Stability Board. It doesn't sound like a lot to all of you, but it actually, they start putting together in the architecture, the infrastructure around the global look at risks in the financial system.
This is like the central banking Jedi.
Exactly.
And saying, we are going to remake our planetary system in finance.
Exactly. And we brought BIS in, Bank of International Settlements, and all these other guys, the IMF, International Monetary Fund, the whole team came in. And by the way, this was almost 10 years ago. So basically where America is right now is further back than we were 10 years ago, where the international community, even China, is actually far ahead of where the US is. Now they've got a much bigger problem, and they have a lot further to go and a huge amount of coal issues, but they recognize it. They're putting in the laws. And so to answer your question again, this is just shocking, and the international community is moving in the other direction at pace and scale. The pandemic and the war has hampered it short-term a bit, but the midterm and the long-term trajectory is completely different than the direction the US is going.
Because the big picture is, you have several different layers of action happening globally. You have as we saw in COP26, we have commitments of governments around the world to try and lower emissions. We have central banks and regulators saying that we're going to force the financial system to essentially reveal whether they are trying to limit emissions or not. And then you've also got investors saying that we want to start moving our money into greener activities. So that's all happening everywhere else around the world, and yet in the US, in essence, it's going back.
Yeah. No, and I talked to a lot of asset managers, basically people who invest your money, your pensions, your individual money, and I talked to them, I said, look, if the big economies don't start shifting, the valuations of the companies that aren't adapting are going to be revalued in highly negative ways. And the SEC ruling in particular, which is hopefully a beacon of light that stays out there. But if you start thinking about real accounting, and for climate, and there's a slew of other greenhouse gases and other things, but I'll limit it just to climate. So carbon's the villain in the car. Ultimately, you can now measure the footprint of a company's carbon emissions quite well, and technically at Cambridge, they can actually do that spatially through using satellites at the university. It's really great stuff. So you can measure pretty quickly. So I can tell you what your footprint is. So that's great. Then you need to start bringing it down. And at some point in the midterm, and the ministers of the G20 said there's got to be a price on carbon. The IMF, International Monetary Fund, said there's got to be a price on carbon. OECD, another think tank, global one, said there should be a price on carbon. And the Bank of England says by 2030, the price should be roughly $130 a ton. So
and it's currently been about $2 a ton, hasn't it, recently?
So imagine if you are in a business right now today, and this is getting really deep in the weeds, but it's really illustrative. If you have, under the expenses of your company, you've got your employees, how much they cost, all the different things. Under your cost of goods sold, you also now have a line for carbon. And you put, even if it's zero today, you know in the next 7 years in that model, and you're doing a financial model, that's going to go in, that's going to have a meaningful effect on the cash flow of your company. It doesn't matter if you're a dry cleaner or General Motors or anything in between. So that's going to deduct meaningfully from your free cash flow. And for those of you that are investors, valuation comes from cash flow times a number, depending on what it, and all of a sudden, if you can imagine, if you think we've had a rough couple quarters in the markets today, imagine when you start have to pricing carbon, or the rest of the world starts doing it. And by the way, you don't need the whole world to do it. If you get the EU, maybe New Zealand, Lord forbid, even China starts doing it, and America sitting out there as an outlier, and other large economies and groups start doing this, it's going to put the United States at a great disadvantage, and their investors and the pension holders and that whole line of theory.
Absolutely. I mean, Mark Carney has talked a lot about the risk of a climate change Minsky moment. A Minsky moment is a kind of panic you have in financial markets when investors suddenly wake up and realize that what they thought was creditworthy and safe isn't. And everybody starts panicking. It usually happens when you have a lot of debt. So someone like Mark Carney thinks that when investors wake up and see the scale of the cost of coping with the carbon emissions, there could be that rapid, shocking price change in the markets as a result.
And this is exactly why you want to start talking about it now. I mean, this is exactly why there needs to be some kind of order so that this chaos, the so-called Minsky moment, but really any kind of market chaos that comes from a dramatic realization that the pricing has been off, that causes capital to get withdrawn from particular firms suddenly, en masse, that has to be avoided. That should be avoided.
And that's what the SEC is trying to, well, I say was, let's not assume they're going to get struck down, is trying to do by changing the way that American companies are going to account for carbon and bringing it more into line with Europe as well.
And I was going to say, again, because the UK and a lot of Europe was well in the front, I was working on a paper at Cambridge almost, I think it's 2015, and exactly to your point, we called it unhedgeable risk. So ultimately, when that moment happens, and the fact pattern we used is, what if you had PIMCO and all the big investors got on CNBC and said, we're only going to invest in green? First thing they're going to find out, there's not enough green investments. Everyone runs to the other side of the boat. The boat flips over, and basically it's unhedgeable. It's literally, it all goes to zero. You get 1-0, it's unhedgeable risk.
So one of the things, other things that's very interesting that's happening right now is that you're getting, in Europe, huge amounts of pools of money, pension funds, corporate plans, all kinds of savings are going into greenish products, or at least products that try and account for the carbon footprint, because they can see what's coming down the tracks, and they're trying to essentially get ahead of it.
In the US, by the way, quite the opposite.
Well, tell us what's happening in the US, because again, something very interesting has been happening in West Virginia. It often starts in West Virginia. But in the weeds of West Virginia's legal system, tell us, Professor, what's happening there?
Very interesting. So, at the same time as we have these big Supreme Court laws, we also have things happening quite locally. So at the state level, both in West Virginia and in Texas, there are now state laws being proposed that essentially would restrict investors from investing in the so-called green or renewables or solar, wind, those kinds of things. So there is a concerted effort here in this country by the fossil fuel industry to actually thwart this transition that you hear Gillian and Michael talk about as happening in a much more robust, predictable pace in the EU and UK. Right? Here in the US, there is a transition, by the way. I mean, it's here. I mean, first of all, we see the climate events, right? But we also see amazing, investment solutions. I mean, we are seeing new technologies. We are seeing really there's a lot of promising work being done on the climate side. But we have here a thwarting of it, and you see it in these laws coming down.
Because, I mean, does anyone in the room know about what's happening in the West Virginia courts in relation to this, or Texas? Right, because, I mean, one of the things that's fascinating is that a lot of this stuff is so geeky, it's happening in the weeds, away from most people's eyes, and certainly away from many of the green demonstrators or people like that who are trying to, focus on the bigger picture issues. But one of the things I find fascinating is that, while you've got this big pushback happening in parts of America, and you've got people like Mike Pence saying that, he regards ESG as, terrible and things. At the same time, the big companies that I speak to in America, the big financial investors, are increasingly either saying that we need to start accounting for carbon risks anyway, no matter what the politicians say, because we can see this coming down the tracks. We don't want to get caught out. Or they're saying, we're global and we can't have one set of policies for America and another set for Europe. So how much impact do you think this is actually going to have in America? Are the big companies like BlackRock, Goldman Sachs and others just going to ignore Mike Pence?
I wish I had his number. We could give him a call.
Was going to end.
No, just asking. I'm trying to be provocative.
That's a very good point, because BlackRock is a global, and they've got to basically function under a variety of regimes, regulatory regimes, and also investor preferences. And they take a lot of European money, they take Asian money, and there's plenty of U.S. money that wants to go in sustainable places as well. So I think in some ways, the good news on this is, as the rest of the world moves in better directions, as large industries in Europe and Asia become more sustainable, both because they want to, and you're absolutely right. I talked to CEOs and C-suite people. They're actually looking forward to, they're asking for better regulation, and they're doing it on their own. In some ways, the courts are forcing both the private sector, they're kind of outsourcing the obligation and neutering that. But the good news is the global piece will allow for certain benefits that to come back to the use. It's basically a positive externality tied to a global system. But it still doesn't, the U.S. is still it's an economy that can function a lot on its own. And it needs this for its own well-being, and also to protect the people against the negative externalities. We all know what the biggest one is, but there's a slew of them tied to business practices right now. And if the courts are going to either neuter or going to require the government, so the government is trying to hand off the responsibility to the private sector, you're getting rid of all the coordination and the reason for a government.
Absolutely, yes. Sarah, do you have a view on this?
Yeah, so, I mean, there is, I think now, increased pressure on the financial sector to really step it up. In the U.S., okay, because you're hearing a little bit about what's happening in the courts. You're hearing a little bit about what's happening with state laws that will restrict investment, and at the same time, we have a sword hanging over us that is limiting our options day by day in terms of how we're going to be dealing with climate catastrophe. So the financial sector, they're the intermediaries, right? They know what's going on, right? So the politicians are going to do what they're going to do. They're a little bit, they're getting in the way here of really the emergence of a more durable, clean, safer economy, and that with a lot of exciting opportunities in it. So. It's a strange moment, as there are a lot of strange moments in the U.S. at the at the moment, and there's going to be, but there's really going to be renewed pressure. I'm predicting on the financial sector to kind of step it up. They are not going to get the guidance that they might think that they would like to rely on, certainly from U.S. financial regulators, from places like the EPA, even the SEC. So it's they're going to have to look at their portfolits, look at them long and hard.
They're going to have to do it themselves. They can't just say the EPA maybe do this. They're going to have to say, I thought we had to do it anyway. But Sarah, I'm going to turn to the audience for a question in a moment. Before I do though, you were in front of Congress not that long ago, up for a position at the Fed. You were known to be a well-known advocate of looking at climate change in terms of regulation and looking at financial stability issues. And you were essentially blocked by Republicans who said that there's no reason for a central bank to be looking at these issues because we have this little thing called inflation to worry about instead. Were you surprised by the degree to which the Republicans lobbied against you and basically blocked you? And do you think that central banks should be looking at these issues? And I'm sure, Michael, you'd like to come in too.
Weigh in after Sarah on this one.
Yeah. Well. Or you can give her a moment to think if you want to.
Actually, let me give you a moment to think, because that's almost a settled point already. The FSB have already, and most of the other central banks, we put together, we being the Bank of England, Bank de France, the Dutch, and I think the Swedes were in this to begin with as well. We said,
and the Chinese.
They came right in the Chinese. And we said, when the last administration came in, international cooperation started fraying. And we felt, well, look, we've got a great start with the FSB and the G20 work. The FSB has already come out and said climate is a threat to financial stability in the system. So that's done. It's
so all the financial Jedi had come out and agreed on this.
It's recognized it. And then we said, all right, we're going to put together a little club of central banks and regulators who are going to focus on climate risk only to kind of further this agreement amongst us. And there was just the 4 or 5 of us kind of thinking we're going to be lonely and sitting there by ourselves. There's like 70, people were pounding down the door, Peru, Mexico. And the great news is, even though the Fed and the big US ones wouldn't come in, the state of California Insurance and the state of New York came in.
So basically all the central banks in the world
it's settled.
Basically joined this club, apart from, this was the era of Donald Trump, apart from the US and Russia. They were the 2 outliers.
Yeah. So the point being is, it's a settled point that climate is a threat to financial stability.
This is true, by the way. I'm not making this up.
Either, so.
Yeah. So it is, it is.
And Sarah, you were trying to take the Fed into this club, and
I really don't come as a climate scientist. I come as a person who understands risk and who understands regulation, and had been at the Fed before, had been at Treasury before. In fact, my vote to be confirmed at the Fed was 97-3 by the Senate, right? My vote.
Which year was that? That was this time round.
Yeah, yes. No, and at Treasury I was, confirmed by unanimous consent. So always had strong bipartisan support. Something was different this time because essentially, as Gillian said, when it was time to vote for the Senate Banking Committee to actually vote on my nomination, the Republicans, led by Pat Toomey, decided they weren't going to show up. They just weren't going to show up. And they weren't going to show up because they had, determined that I was no way qualified, because how could I be qualified if I'm talking about climate? And
having already served at the Fed and the Treasury.
That's right. That's right. So I would say that was a surprise. Yeah, that was a surprise. And it's unfortunate. I'm going to be fine. The Fed will be fine. I think everything is going to work out just fine. But we do need to figure out how climate is going to get understood as a phenomenon that does have financial stability and economic ramifications. That has to be grappled with. It is a risk staring us in the face. I mean, some thinking now really is going to this idea that part of the reason why we're experiencing some of the supply shocks that we're experiencing is that we've lost economic resilience. Why? why do we not have resilience? Like, what is going on? How have we eroded some of our ability for the supply curve to move back to a place where prices are once again low? What is happening in the U.S. that we have this lack of resilience? And these discussions are going to lead in different directions, but I guarantee they will also lead right back to climate.
I should say, by the way, that this is the first time that Professor Raskin, or Sarah, has actually spoken about this in public, in a general audience. So
how did I do? Is that
You've been nothing but dignified throughout this whole process. But yes, sorry, Michael. And then we'll ask for questions.
I'm just going to give everyone here a really quick view of what financial stability means, because it's kind of an obtuse kind of phrase. How many of you have ever had a car loan or lease? Okay, great. So in the United Kingdom, it will be illegal to sell an internal combustion car, a brand new one, in 2030. And the reason for that is a variety of ones. We call it free riding negative externalities, which is basically pollution and carbon that come from cars. We want our people to have healthier lives, and we want to stop climate change. So cars, car leases, car loans, those sit either on the portfolios of your banks, which many of you either have deposits in or shares in, or they get bundled up, let's say 250 or 300 different loans or leases on your cars, get put into the equivalent of this class. It's called a special purpose vehicle, but they bundle them all up together, and they sell them in the market as a bond. It's an asset-backed security, it's a bond.
It's like making sausages with bits of meat from all over the place.
And guess what? You don't know it, but all of you have some of that in your pension because basically BlackRock and all of these guys buy it. Now, if I told you right now this particular glass was filled with loans and leases for automobiles, internal combustion ones, worse yet, diesel ones. Now, would you buy that at its face value? Would you pay it over a premium, or would you pay a discount? Now, one other little piece of information. Most of you know you pay the preponderance of your loan or lease at the end, or you give the car back. So the banks, their stability is dependent upon understanding how you're going to behave. And most of those loans run anywhere from 3 to 5, 6, 7 years. And oh, by the way, that law changes pretty soon. So you may not choose to personally buy it, but you probably own shares in the bank, in these bonds. And this is one little example. This goes across the entire economy. This is what financial instability looks like when that penny drops and everyone realizes this is not worth what you thought it was worth. It's at a deep discount, and that's coming right out of your pension.
And
that's it.
I would add to that. I mean, the metaphor I use, and I used during the subprime crisis in 2008, was that it was like sausages. You take bits of meat from all over the place, chop it up, mix it up, and you only have to be told that one cow is dodgy for you to stop eating sausages altogether, because you don't know which bit of meat in which sausage is actually dodgy.
Yep.
And so if, to say, we have this issue with car leases because of climate change, or Florida mortgages, if we start seeing sea levels rise in Florida and suddenly property values crash there, sorry all of you who have Florida property, again, you have this kind of food poisoning problem within the financial system. But anyway, questions. Okay, you all put your hands up at the word Florida property. Okay, let me start right at the very back, the woman back there, and then we'll come forward. And we have lots of questions. Please keep it very short, brief.
Margaret Hansborough, I work on steel and decarb. Really curious to how regulators can start to look at specific pathways for specific products, because there is a lot of nuance to not just clean energy or electricity, but steel, concrete, plastics. Those are going to be really tricky to evaluate. RMI is working on this, being able to compare apples to apples for banks, but where are the regulators in this conversation?
The Bank of England just finished a financial stress test on our entire banking and insurance community. We basically asked them to basically tell us where their concentrations were, and look at everyone knows the carbon-heavy sectors. Everyone knows it's steel, it's cement, it's auto, and so we know where that is. We know their concentrations are, and not only did we just have them do that, then the most important thing is we had dialogues with them. By the way, there are stress tests taking place around the world with different regulators. So
with the exception of the U.S.
Yeah. Even Singapore has done it. China has done it. United Kingdom, the EU. So to your point, country isn't, but most of the world is. The regulators are specifically looking at concentrations of difficult sectors and stress testing the banks and the insurance companies.
We have a question just over there on the right there. Yep, and then we'll come forward a bit. So.
Hi, thank you. Anne Perrin, I'm with a firm, a global investment firm called Temasek, Singaporean. Yep. So my question is domestically based. Curiosity to hear your reaction. We could see a new president come in a couple years from now. We could go back to a Republican administration. And I agree with you, Sarah, on what's happening on Capitol Hill is just going to stay a little muddied. But my more concern is for folks like Larry Fink, who you mentioned it, and BlackRock and a lot of the things they've been working on, and firms like mine, and what we might see out of the regulation that comes out, or lack thereof, and movement, or even offices that have, unfortunately, like people like John Morton over at Treasury working on this issue, that office will close, and then they won't keep getting to be able to move forward. So my question is just, what do we do if administration changes and we get a different administration, a Trump or a Ron DeSantis or whomever in 24? What happens then?
Oh, it's just a great question. And I can assure you that every decision that is getting made now in the context of climate and finance is being looked at really with your prism, because there's obviously value in putting in place certain actions and certain safeguards. But if they're going to be ripped off in 2 years, I mean, you have to weigh that against kind of the uncertainty that's created, the costs imposed in complying and then not complying, and the uncertainty, and that all has like real effects. So we are and I think this is, not for better, but for worse, we are in a highly polarized environment where those decisions, it makes it very hard for firms like yours to actually figure out what exactly we're going to do, because, how do we look at this from a longer term perspective? Because we don't know. We really don't.
And of course, what people are trying to do with the central banking community is create predictability. We have a question here, and then we'll go on this side.
Yeah, so West Virginia and Texas, into the geeky weeds here. What are they trying to do? Which investors will it affect if these things pass? Is it just like their state pension fund, or does it go broader than that?
Yeah, it's a great, and I will have to get into the weeds and sort of read each statute. I'm not even sure that they are identical, but essentially what they are going to do is they're going to limit investor choice. They're going to sort of quash innovation, right? Because there's a lot of new interesting firms doing important work, and they want capital, and they deserve capital. And to sort of take investors' hands and kind of handcuff them to an economy of the past is actually one that is very detrimental to a vibrant, growing economy. So they are troubling. Some of them, they might have features like gates, like where they keep you from pulling your money out, which I think that's also a troubling feature. But we have to read the details. We've got to read the details of each one. I would say that the top line message is that these statutes are real. They're anti-free market, but they really are anti-innovation, and they should be resisted.
One of the problems that any big financial company has today, we're hearing on Moral Money, is that if you're trying to devise products to sell across America, you could end up with a situation where California requires ESG awareness and Texas bans it. So what the earth do you do? I was literally talking to a big European asset manager last week who said, we've never imagined ever that anything like this could happen for America. We have a question down here, and then over there. Oh, I'm sorry, I've got so many questions. I can see almost over here. Well, I'll actually go, okay, we'll do 1, 2, yeah, there, and then.
Thanks, I'll be quick. In an environment where we have a so-called small government pro-business faction that's acting the opposite in this country, will EU's CBAM be the club we need beat over our heads? And can you explain to everybody what that is, the carbon border adjustment mechanism?
Okay, and then if you pass the microphone over there to Yuan, and we'll come back to you in a moment.
Yeah, that's a blunt tool, and I'm not a particular fan of it, nor is the IMF. It's a great thing, just for everyone's benefit. What it says is basically, if you want to, from the United States, to import into the EU, you have to meet our environmental, our climate thing. If you can't, you're not coming in, or you're getting a huge adjustment and a border adjustment on a cost on that. It's often used for trade, ways to obstruct trade. I agree, it could be a very blunt tool, and threatening it might be useful. I think, to Gillian's point, what corporations need to do, they need to kind of pick what they're going to do on a global basis, because they can't do 7 different formats for 7 different regions of the United States, not to mention the rest of the world. I get what you're saying. I think something more along the line of maybe a carbon taxes. And I know this is together in groups. You're not going to get everyone together. G20 is not going to do it all at once. But if you can pull maybe the EU, New Zealand, China, as a group together, kind of like that group of central banks did, and then all of a sudden people want to start joining the club. You're not going to get everyone in the club together, but if you can get some meaningful pieces of economic power and might doing it, it kind of leaves the odd people out in a tough spot. So it's not technically a border adjustment, but it kind of leaves them in a tough spot. And by the way, this is not anti-business. Actually, making the transition is the greatest alpha opportunity of any of your lifetimes. It's the best opportunity to have sustainable, i.e. businesses can last a long time, good jobs, better products, not to mention all the goodies that come with clean air and no pollution. So it's not anti-business.
Right. We've got a question, I think, actually, I was going to say actually over, okay, there and then there, quick, yeah. Yeah, there. And then if you can then just pass the microphone forward to the gentleman in the blazer.
Mine's just a follow-on from the border tax one. Is, Michael, your view, do you think border taxes will come in Europe? And Sarah, is it something that could happen within the states of America?
Yeah, the Europeans have certainly been talking about it.
And then over there.
I think they're very hard to implement, and I think just the pure talking about it, hopefully. It just seems that from this discussion here and the time I've been in the United States for the last 4 or 5 days, there's so much preoccupying everyone's, I don't even know if they did pass one, if you'd even notice. Because you've got enough, there's enough going on here to start worrying about, that.
Yeah.
So they are talking about it. I don't know the immediacy of it, but it is certainly an open discussion.
Yeah. Yeah, and in the U.S., it's the initial reaction to it was one that was considered like, is this a protectionist mechanism? Is it going to run afoul of the WTO? And you hear now, just because of the urgency of things, that this might be something that has to get explored.
Right. One, and you should say briefly what you do, and we're going to have to make this the last question, sadly.
Perfect. My name is Juan Carlos, and I'm a climate negotiator. So I heard from this panel that financial institutions want to do the right thing because they understand that it's also the right thing for business and that politicians are on the way. So if they want to do the right thing, why is it that they are not using their lobby muscle to ask politicians to do the right thing? Or is it that fossil fuel companies' contributions are still higher than those from financial institutions?
It's a great point. Yeah. And they need to be doing better. They really need to be doing better, because I have to say they do what they sort of say with one hand, they say differently with the other hand. And if we're going to have any, like a meaningful, non-chaotic, orderly forecast transition into this new economy, we are going to have to see the financial institutions work in a much more conscious and coordinated way and working on the same goals. They can't be kind of giving with one hand and taking away with the other. So they're going to have to, and they're going to have, and in the U.S., where our regulatory system is, it's not a monolith. It's a whole series of different alphabet soup.
Warren.
Yeah, you could call it a rabbit warren. There's going to need to be greater coordination on the regulatory side as well.
Can I just ask, very quickly, maybe go for 1 minute, what can all of us in the room do about any of this? If we don't like what we're seeing, what can we do? Do we have to go and yell at our friendly local bank manager and tell them to change the way their bank is doing their corporate lobbying? Do we have to get out and start trying to vote in West Virginia? What do we have to do? Do we have to take your classes, Professor Raskin?
Okay, so little things. I mean, you can certainly, we're running out of time, but you can certainly you go to your bank and say, I'm moving my money because I've checked out. And by the way, you can do research on the banks. You can see which ones are most active in it. You can see where they invest in. I mean, your biggest bank is also the biggest holder of oil, gas, and coal in the world. And remember I talked about that carbon tax? Or if there's ever a tax on that, what would that do to their assets and their balance sheet? So understand your bank. Understand what they invest in, what their values are. And that's a good first step from at least from the banking point of view.
Professor Raskin, what would you tell your students who probably are...
So they're disillusioned. The students are just, you know, they find this just astonishing that the financial regulators can't get this right in the U.S. It's just astonishing. And you know, and what they are looking for, and what I think we're looking for in the next generation, and the generation after that, is we are looking for a resilient, durable, inclusive, clean economy, and without artificial legal political barriers being put up. We need to move into this new state. It's going to happen whether the politicians or different sectors want it to or not. It's going to happen, and it's a good thing if we could just let it happen.
Well, thank you. I think that's a great note to end on. So thank you both very much indeed.